So good afternoon, everyone, and welcome at this interesting webinar on the impact of the new pension system in the Netherlands. First of all, thank you very much, Maarten Racing of Montae Partners, for sharing your expertise with us. As some of you might know, we have already done a webinar on this topic in 2020, so time flies. Maarten has then explained to us what was about to happen in the pension world, and now it is July 1st has passed, and the new transition, we can say, to the new pension system has started. The House of Representatives and now the Senate as well have adopted the new law. So we're very happy to have Maarten with us, who is the expert in pension, but not only, also in income protection and sick leave insurances. Montae Partners, as a global company, has a lot of experience in advising international companies on their terms of employment, but also, of course, pension. So I'm going to leave the floor to you, Maarten. If you have any questions, please put them in the chat and we can treat them along the way. And of course, at the end of the session, there's also possibility to ask questions. So Maarten, I give you the floor.
Yes, thank you, Sylvie. Yes, I'm Montae Racing, pension consultant at Montae Partners. And I think it's good to do a brief introduction of actually who we are as a company, what our services are. And of course, from there on, we can go to the impact of the Dutch new pension system. First of all, I think it's good to know that we provide services to employers and works councils, and not only in pensions, like Sylvie said, but also in healthcare, disability insurances, and also international labor mobility. For example, if you have expats working in the Netherlands, or for hired in the Netherlands but working abroad, we also help our clients with setting up the insurances local, because probably some insurances are not applicable anymore when an employee goes abroad. So therefore, I think it's good to know that we also provide services in that area. And we help works councils, of course, also with courses about pensions, about income protection insurances, because if you change the employment conditions, you always need to have the consent of the works council. And therefore, it's good to have the works council also the knowledge level of the works council also at a certain degree. So we help them to give them courses and to help them set up the different pension topics. I think it's also good to know that we are founded in 1997, so actually quite a long time. We already exist and we are working with more than 40 employees. So therefore, we have different offices in the Netherlands, Rijswijk, Gouda, and Eindhoven, but also we are at the Caribbean. So if you have a company at the Caribbean, please let us know and we can help you also there. It's our DNA, transparent, to be no nonsense. So of course, I'm trying to explain this as easy as possible, as refreshing as possible, actually, because we are talking about pensions. But please let me know if you lost in information. Please chat Sylvie, and we can explain the things in a different way. No problem. So of course, it's our topic to be more transparent, to be as transparent as possible. Now let's go to the new legislation. Of course, the new legislation is about a lot of topics, and I'm not trying to give you a headache with this slide, but when you are talking about pensions, I can sometimes imagine that you get a headache, because it's not only pensions, it's about cost, it's about compensation, of course, employee benefits. Like I said, you need to have the consent of the employee when you're changing it. So you cannot change a pension scheme just when you like to, as an employer. You always need to involve your stakeholders. So therefore, there's a lot going on, and a new system, of course, there's also a lot going on, because every company needs to change their pension scheme, and therefore it's important to know what impact does it have. And we'll try to explain this during this webinar. But actually, why do we need a new pension system? Because our Dutch pension system is one of the best in the world. But actually, this pension system was already created in the 50s. And now it's no longer future-proof, because our current system is mainly based on the fact that the employed people are paying for the pensions of the retired people. So the system is more based on workers paying for the pensions that now are retired. And actually, this group is changing. We get less employed people, and therefore this system is no longer future-proof, because the employed people are going down, and the retired people, because of the aging and the life expectancy is increasing, the group become very big. So therefore, it's not future in line with the demography, you could say, in the Netherlands. So therefore, the new system is all based on more individual pension pots. So each employee gets their individual pension pots. So with this system, you will avoid that the current workers are paying for the retired people. No, you are saving for your own pension account, actually. So this is all what the new system is about in one line, you could say. But of course, it has impacts on your scheme, if you already have a scheme as an employer. So therefore, I think it's good. What impact does it have? If you look at the scope, and we will go through these points during this webinar, like I said, it impacts on 100% of the employers and employees, the new system. There is a transition period between July 2023, so actually we just got started, until December 2027. And this means that all companies in the Netherlands and all pension funds have the possibility to make their current pension scheme in line with the new pension system, new pension legislation during this period. So therefore, it's up to you, up to the employer to decide when to start. But I think it's good to already be aware of the changes, because yes, to make some changes in the pension schemes, of course, is not done within 6 months, for example. There always is a long time period needed to do the necessary changes. Now, the change impacts are based on pension outcome, the premium, partner pension, recruitment, pay structure, and also part of total reward package. So I will explain what are the differences there, or what is the impact per topic there. And also the scope of the new pension system is that there are new and more focuses on the individual and sustainable employment. And what I try to say with this is that in the new pension system, it's also possible to, for example, provide an extra payment for employees who are going with early retirement. And for example, it's again possible to give employees who are 3 years before their state pension retirement age, to give them an extra salary, so they are able to go with early retirement. In the past, it was not possible, because you get a 50% fine, you could say, an interest fine by the tax authorities, because this was not allowed, that you were sent employees with early retirement and give them an extra salary. It is now again possible. So 3 years before state pension retirement date, you, of the employer, can give the employees an extra payment. Of course, there are a maximum based on that, but a payment without paying the 52% fine that was in the past also applicable. Like I said, that impacts 100% of the employers and the employees, but actually, what group are we talking about in the Netherlands? So here is a slide about the situation in the Netherlands. We have 430,000 companies with more than one employee. So of these companies, 78% do participate in an industry-wide pension fund. As you may know, we have industry-wide pension funds for, depending on the activities of the company. For example, government companies have ABP, metal constructions have a pension fund, PMT. So depending on the activities of the company, those companies don't even have a choice for selecting their own pension scheme. They do have to participate mandatory with this pension fund. So over 78% are mandatory participating in industry-wide pension fund, and it represents 75% of the employees. 130 corporate companies have their own company pension funds. So they have set up actually their own pension fund because they are very big, more over 1,000 employees probably. So this represents 7% of the total employee group in the Netherlands who are participating in the company pension fund. and 20% are insured through the pension insurance or PPIs, the premium pension institutions. So this means that the 20% group can set their own pension scheme as a company, and they can self-select the pension provider. Achmea, Zwitserleven, all pension providers are actually known in the Netherlands. They can self-select their pension principles and also their pension schemes. And this represents 18% of the companies. So this is actually the situation in the Netherlands, and a deviation between pension funds and pension providers with an insured pension scheme. In average, the average yearly premium per employee is 5.4K. So this means around 14% of the salary. This is being spent on pensions. So there you can see what actually the pensions costs are in the Netherlands. It's quite high, 14% of salary. Actually,
can I also ask a question, or is that for later? Let me know.
Yeah, I think it's fine. Of course, yeah. Let's do it. Let's hear.
Yeah. No, because I see that the percentages of the employees come out to 100%. So does that mean that every employee in the Netherlands has a pension? Because I know of employees that don't have pension.
Yeah, the percentages on the right are based on actually the facts on the left. So on the left, we are not at 100%, 98. So therefore, 98%, almost all companies in the Netherlands do have a pension scheme. But yes, still there are still companies who don't offer a pension scheme because they are not obliged by law to offer a pension scheme, but it's a small percentage. So
Okay.
2% is still not a pension scheme of the employers with more than one employee active.
Okay, thank you.
Okay, you're welcome. Actually, about 75% of all the employees still has a DB plan. And what I mean with the DB plan is a defined benefit plan. A defined benefit is more like a guaranteed pension plan. And probably you already know, in the future, in the new pension system, defined benefits plans are no longer allowed. But almost all industry-wide pension funds are still have a DB plan, a defined benefit pension scheme. So the major change what will go on is within the industry-wide pension fund, because they have to change their defined benefit plan to a defined contribution plan. This is the new system, defined contribution. So about 75% all of the employees will change from a DB plan to a DC, a defined contribution plan. The total amount of pension assets is 1.5 billion euro in the Netherlands. So it's a really, really big amount, of course, and therefore this is a really big change. Actually, I think it's one of the biggest in Dutch history, because there is a lot of money going on because of the change of this system.
Maarten, I have another question in the chat. From Michiel, my age is above 40. What are the negative and the positive consequences if my employer starts the transition to the new pension system?
Yeah, I think it's best to wait to another few slides, and I will explain more about the different age group and what the impact will be on changing the system. So of course we will go more into detail what the impact is on the age group, and of course if his answer is still not, if his question is still not answered by then, of course please let me know. But I think it will be done in the next few slides. Timeline transition period. Like I said, in 2020, we already had the first webinar because the pension agreement was concluded at the moment. Minister Koolmees, the Dutch minister at the time, they presented the pension agreement, and actually the pension agreement was more legislation in concept, you could say. So this was an agreement, and from there on, the legislative process started. Intentionally, it was the possibility, or they intended to start the new system with the 1st of January 2022. Then they postponed it to the 1st of January 2023, and again they postponed it to the 1st of July 2023. So actually 2 times postponed, but actually now 1st of July, the first and the second chamber in the Netherlands were agreed to the new law, and the law is in force as of the 1st of July 2023. So this means actually that all new schemes, and if you are in a company that set up a new scheme, they all needs to be a defined contribution, being with using a flat rate premium. I will explain later what I mean with that, but all new system schemes need to be a defined contribution based on a flat rate premium. So if you have a company and you also see the next, or if you have a company with a pension scheme and an insurer or PPI, you see the 1st of October 2026 as next deadline, you could say, because before that date, you need to have an implementation and a communication plan ready. In the legislation states that before this date, you need to notify your pension provider with this implementation plan and communication plan. So you need to already know what your future pension scheme will be, so they know they need to change in the future. So this is actually the deadline. So before that date, you already need to know what to do. There is also a deadline for companies in pension funds, the 1st of January 2025. Then they need to have the new scheme designed and the transition plan ready. But actually, this is a small group. So probably you are in the other group, employees with a pension provider an insured pension scheme. The 1st of January 2028, this is the final date. So this means that your pension scheme, if you all now have a pension scheme, this needs to be in line before the 1st of January 2028 with the new pension legislation. So new schemes need to be in place, and all new hires need to have also a flat rate premium. So this is the final date. The 1st of January 2037 is the end of compensation period. This means that, for example, you can agree on a compensation because employees will get in a worse pension scheme, you could say. You could agree on giving them extra compensation, so extra pension premiums that go into the pension pot. But actually, this is only possible for the duration of maximum to 2037, because they give an extra premium tax possibilities of 3%. I will come back to that later, but this is the end of the compensation period. So this is more the total timeline. And I think it's always impossible to already start with communication to the employees, because the new legislation started now, and probably your employees will ask, what is the impact for them based on the new system? Like the first the first question in the chat, what is the impact on me? Of course, all employees will have the same question. So I think it's good as an employer to already let the employees know that you are working on this process and that you are diving in the information of the impact, and that you, of course, will come with with the possibility of changing the system. But I think it's already good to let the employees know that you are working on this process, so that they are aware of the fact that you are working on this. So actually, yeah, be informed or act now. Because you saw the date of the 1st of January 2028, and possibly you think, okay, that's all in 5 years. Why act now? Because it's still a long time. Actually, but only in the situation that you are participating in an industry-wide pension fund, it's just enough to be informed now, because the industry-wide pension fund is always in the lead. The industry-wide pension funds needs to adapt, needs to change the new pension schemes to the new system, and therefore, as an employer, yeah, you just have to follow the pension fund, you could say. But in the other situation, when you have your own company pension fund, if you have a pension scheme and an insurance company, you as an employer are in charge, of course, in changing the system. But also you need to inform all the stakeholders, possibly the unions or the Works Council, and also the individual employees. So to be able to do that, of course, it's not a 1 year process. I think it will take you more than 1 year. It depends on the size of the company, of course. But if you have your own Works Council, for example, it's really important to already involve the stakeholders and possibly provide them with a course to upgrade their knowledge about pensions, so that they are able to also decide on the new pension system that you will, or that you want to agree to agree on. So this is, I think, something important to know, that if you don't participate in the industry-wide pension fund, I think it's important to already act now and to be informed, and also set the first steps towards the new system. Then what is the new system all about? And the current system is mainly based on a defined benefit, because almost all pension funds, industry-wide pension funds, are based on a defined benefit system. But like I said, in the future, it is no longer possible. In the future, all pension schemes need to be a defined contribution scheme. And of course, this system we already have in our current, this scheme already have in the current system. And as you may know, a defined contribution, like the word says, the agreement between the employer and the employee is based on a premium. You are agreeing on a certain premium that you will invest in a pension pot. So the premium is secure, but actually the benefit is insecure, because the premiums go into the pension pot, and it's depending on return on investment and life expectancy, and based on certain variables, what your actual pension outcome will be. So this is a defined contribution system, and like I said, all new pension schemes will be such a system. And the current system, defined benefit, if you still have such a system, you need to change it to a defined contribution system. There was also a change in the insurances. Partner and orphan pension will change. I will come back in a few slides what the actual changes will be, because you need to change your insurances in the case of death, also in the new system. This is the second change, you could say, in every pension scheme.
Maarten, I have a question in the chat. Does the new pension scheme need to be implemented for the 2% of the companies that are currently not obliged to have a pension plan?
No, that will stay the same. The system of the mandatory participation to industry-wide pension funds, that remains the same. So no changes there. And still, if the companies, the 2% of the companies that still don't have a pension scheme and are also not obliged to participate in the pension fund, they still have the possibility to not offer a pension scheme at all in the future. So no changes there. Yeah, it is common, of course, to provide in a pension scheme, but it's not mandatory to do. I will explain the impact of the new system based on two companies, or two employers. Employer A with a DC scheme, a defined contribution scheme with a graduated skill, what we see a lot currently, and an example of employer B having a DB scheme, a defined benefit scheme. I'm talking here about companies, so they have their own scheme, right? Not industry-wide pension funds, but the 20% group, you could say, the insured pension schemes, because there is the big change going on, and there the employer need to take action by themselves. First, employer A with a defined contribution scheme. And this is a very common defined contribution scheme using a graduated skill, meaning by age group, what you see on the horizontal line, 20 to 25, 25 to 30, age brackets of 5 years. And every 5 years, the premium goes up. It starts at 7.7 and it goes up to 30.7 when the employee is reaching the age of 65. So this is really common. This is the total premium percentage, employer and employee contribution together. And of course, it's possible to ask an employee contribution. It's not mandatory, of course, to ask an employee contribution. You can change that if you like to. You see here percentages. To be clear, these are always percentages of the pension base figure. So not percentage of the salary. We are always talking about pension base. And this means salary minus the so-called offset amount. And the offset amount in 2023 is 16,300 approx. So you always need to deduct the 16,300 minus the salary. That leaves the pension base, and pension base times percentage. This is the premium that goes straight into the pension pot of the employee at the insurance company. And this is what the current DC schemes are all about. So what is actually the impact? If you have such a pension scheme with a graduated scale, and of course the percentages can be different in your scheme, but the impact is the same. You actually have two options, because the new pension legislation says that you can't use this graduated scale, the premium percentage that go up, are no longer allowed in the future. So in the future, your pension scheme needs to be a defined contribution scheme, and that's already in line with new pension system. But also the premium needs to be based on a fixed percentage. And what you see here is the fixed percentage of, example, 15% for all employees. And not looking at age, all employees need to have the same percentage, at least all new employees, because what the new pension system is telling us is that all new employees, as of the 1st of January 2028 at the latest, need to be in a defined contribution system using a flat rate premium, a fixed percentage. So if you already have a graduated scale with the premium going up for the current employee group, it is still possible to keep that option. You can actually then have two schemes. One scheme for the new hires using the flat rate, and one scheme for the current employee group using the graduated scale. But actually then you have two schemes, more administration you could say, but then still you don't have to compensate the current employee group because they keep the old system, and the new hires you will be enrolling to a new system, to a new scheme with using a flat rate of 15%, 10%, 25%, that's up to you. The maximum is 30% in the new tax legislation. So the maximum flat rate percentage is 30%, 30. So if you look at actually option one, you could offer two pension schemes. So this means that current group stays in the graduated scale and the new hires go to a flat rate before 1st of January 2028. You can self-select the date, of course, of this change. If you say, okay, my pension contract at the provider ends at the 1st of January 2025, so you need to conclude a new contract at the provider, possibly it could be a good moment to say, then we will end the enrolling of new hires to the current scheme. And from that moment on, we will start a new scheme for new hires using, for example, a rate of 15%. And from there on, we will have two schemes at this provider or possibly another provider, because you are free to go to another provider, of course, when the contract ends at the current provider. So that's up to you. Then you have two schemes. And it sounds good, because then you don't have to compensate the current employee group, because they still can have the old scheme even after the 1st of January 2028. So the old employees will have the current group will have the current scheme, actually as long as they are in service at your company. So that's, of course, this scheme can be 10, 15, 20 years following you could say, depending on when the last employee go with retirement or will leave the company. So you still can have two schemes. But if you do that, there might be some difficulties, but let me show, because for example, if you hire a new younger employee, this employee could say the new hire will get 15%, and the current employee in the age group 20 to 25 still have a 7.7 premium percentage. So it means that the new hire will receive a higher premium, 15%, than the current employee already has in the same age group. So there might be some difficulties between the employment conditions between those two employees. So it actually could mean that your new hire will get a lower salary because the pension premium you are paying for this new hire will be higher than the current employee at the same age group. So there might be some difficulties here between the younger employees, and of course, and then when you look at the older employees, maybe they won't change jobs, of even maybe of course you don't like to for the old employees to leave your company, of course, but on the other hand you could say the old employees will stay always at your company, because they know if they will change jobs and go to another company, they will get a flat rate, and possibly it will be lower premium than the current pension scheme at your company, because the age group of 65 will have a premium now 30.7%, and in a new company possibly 15%. So it means, I don't think I will change jobs because of this situation, or he should be compensated in salary when he's starting at the other company. So there is a lot going on, of course, even when it comes to recruitment and leaving people, for the change of this system and having two schemes at your company. Another possibility for this situation is to go to a flat rate premium for all employees. So you have one pension scheme using the same percentage, for example, 15%. But actually then in this situation, then you will pay the younger employees direct a higher premium because they go up to 15%. So of course, good news for the employees, but bad news on employer cost side. And the older employees, you have to provide a compensation because they will get a 15% premium instead of 30 or 25%. So there you see on the right, compensation. You can't change a pension scheme for the older employees without giving compensation because you're changing the employment conditions, and therefore they need to provide, you need to get the consent of the individual employee, not only from the Works Council, but also the individual employee to make this change. So therefore, if you do this and go to a flat rate premium, at first, your pension cost will be higher because you have to give the compensation, and the younger employees will have a higher pension premium. But in the long run, you can make it more like a budget neutral, you could say, because at a certain moment, the older employees will go with retirement, and then, of course, that will lower your total pension cost. But this is also a possibility to go to a flat rate, but then you need to agree on a compensation with the older employees, actually. What we see is if you change the system, the new hires will be on a flat rate, or the current employee group and the new hires go to a flat rate using one or two systems. In the future, the pension premiums will go down as an employer. At first, they will be higher, but in the long run, the total pension cost will go down because the older employee go with retirements, and the young employee will all have a flat rate, and most certainly the flat rate will be at a level of the current budget of the employer. But in the previous scheme, your pension budget should increase because of the graduated skill premium. So therefore, what you see here on the total premium line is going down in 2036, for example. It goes down instead of the current budget, what you normally have for your pension scheme, the green line. So, and actually, it's good news on employer side in the long run, because it means that you will save on pension costs. But actually, that also means that the pension benefit, the level of pension schemes are becoming lower in the future because of this situation. Of course, when the costs go down, also the pension outcomes of the employees will go down. And this is what you see in 5 to 10 years period, the pension costs will go down because of using this flat rate. That also meaning that the employment conditions on pensions are going down for all employers in the Netherlands. But there is a possibility, of course, to avoid this, but I think it's good to know that this situation will happen in the future. And therefore, I think it's good to know what you can do with this situation. For example, what we discuss with a lot of our clients is to always make calculations based on your current situation and a possible flat rate percentage that you want to introduce, that you want to like to introduce. So to make calculations per individual or per age group, 20 to 30 or 20 to 25, 25 to 30, to make calculations. What is the current scheme level? What you see here on the left, 100%. And if you introduce a flat rate premium for all or for new employees, what is then the situation in comparison with the old situation? And then you see here in this situation, all employees will, in all ages, will have a less, the level of the pension scheme is lower in the new situation with using a flat rate than in the current situation. And the problem, you could say, will be higher when you're looking at the older age groups, as 55, 60. This means if you're using a flat rate, 11.8%, in comparison with the current graduated skill pension scheme, it means half of the pension outcome for this employee group. So therefore, this is always very important to look at all employee and the total employee group to make these calculations based on pension outcomes, old versus new situation, and then based on this, make your decision, okay, what level do I want to set my pension scheme now, but also possibly in 3 or 4 years, maybe you have to upgrade your pension scheme to be in line with your current employee benefit on pensions. What you see here is more like a box plot, we call it, and this is always based on different economic scenarios. And what we do is to make 2,000 economic scenarios. They are issued by the Dutch Federal Bank, DNB. They have a 2,000 economic scenario set with good, bad, neutral, weather economic scenarios. And this scenario set we always use to make our calculations for all the employees. So for each individual employees, we do the 2,000 economic scenarios. And what you see here, for example, in the 20-25 age group, 37% is the lowest scenario, you could say, or this is the 5th percentile. So there is still 5% lower scenarios than this. And the 328% is the 95th percentile. So it means that only 5% of the outcomes are giving a higher pension outcome than this one. And the 100% is the median. So 50% of the scenarios are better, 50% of the scenarios are worse than this outcome. So it's because we're always talking about defined contributions and we don't know the exact outcome, we always use these 2,000 economic scenario set to provide companies and works councils with an idea of the pension outcome. So I think it's good to know the background of these calculations, because this is key to do in every pension transition from DB to DC or from graduated skill to the flat rate premium. This is more the basis, and based on this, you can go forward to set the new premium level. What you also can do is we call it a unique M&P, Montae Partners solution, is to introduce a progressive flat premium. And this sounds a bit weird, I think, but of course, like I said, you have to introduce a fixed rate, a fixed premium rate for all new hires in the new system, or you have to change your current system to the fixed premium. But also you can agree on to set now, for example, a 15% flat rate premium, and then again, determine the total budget in 3 years, and based on that budget, you make a new calculation, and maybe you can then increase your flat rate premium from 15 to 15.5%, and depending on the budget you already allocated at this moment. So it's more like a progressive flat premium. The premium can go up in the future to avoid that the current employee group has a good employment conditions and that they are more in line with your current employee conditions. So I think it's also very good to look after this possibility to actually evaluate every 3 years what is the budget, what is the premium, the total premium of the pension, and is there a possibility to upgrade the premium percentage based on the new system. Then the employer B with a defined benefit scheme. Like I said, the defined benefit scheme is no longer possible, and these companies have actually 2 options. You can switch your defined benefit scheme to a defined contribution scheme with using a flat rate for ultimately 1st of January 2028. So it's more like you go at once from DB to DC with using a flat rate premium, and so new hires can join this scheme, and the current employee group can also join the scheme. So you still have 1 scheme. Or the second option is to still first do the transfer from the current employee group that have the defined benefit scheme to a DC scheme using this graduated skill. So the premium goes up from 7.7 to 30.7, for example. You still have the possibility to introduce that scheme if you have a DB scheme, but again, then at the same moment you close that scheme. So new hires won't participate in that scheme with the graduated skill, because new hires need to be enrolled in a second scheme using the flat rate. Sounds difficult, but this is more easy for switching the defined benefit scheme participants to a defined contribution scheme, because the current defined benefit schemes are all based on premiums that are higher for older employees than for younger employees. And this graduated skill is more foreseeing in this fact that the pension outcomes will be more in line in comparison with the current situation. So you still have the possibility, but if you do so, you have to do it before the 1st of January 2028. So I think it's good to take a look at that and at the different possibilities. This was the pension accrual part, the pension outcome and the pension retirement. Of course, I can imagine it's a difficult situation, but if there are questions, please ask, or of course reach out afterwards. It's always possible. Second topic is the insurances in case of death. I said there is also impact on the partner and orphan pension. Possibly, you know, in the case an employee dies, the partner will receive a lifelong benefit. In the children, the orphans will receive a temporary benefit. Currently, the orphan pension is often insured until the 21st birthday of the child, or 27th birthday of the child in case he or she is studying, and this is the current system. In the new system, these partner and orphan pension insurances will also be insured, but the determination of the insured amount of partner pension will change. For example, what I show here on the right is an example calculation of the partner pension in the current system. So this is an example what is often being used in every pension scheme in the Netherlands. For example, the employee earns a salary of 65K. They use the offset of 16,322. This is a 2023 offset. Of course, the offset can be higher than this amount, right? So it can't be lower, but it also can be higher. It's often used that it's 17 or 18K, but this is the 2023 minimum offset. The employee age is 42, and the retirement age in schemes is 68. This is actually in almost all schemes, the retirement age is 68. So the possible years of service is 26, 42 to 68, of course. The accrual percentage is 1.16% per year of service. Now, this is something that is written down in Dutch legislation. This is the maximum percentage that is possible to use to determine the amount of partner pension. So when you make the calculation, what I did is 65 minus 16,000, the offset times 26 years of service times 1.16% is 14,681. So meaning, if this employee dies, the partner will receive a lifelong benefit annual gross of 14.6K. So it is 22.6% of the salary. This calculation is no longer allowed in the new pension system. So all pension schemes need to change on this topic, because new pension system says we don't use this calculation anymore. We use a fixed percentage of the salary with a maximum of 50%. So what you need to do in your pension scheme is to determine one percentage, maximum 50, for all employees. So this employee, if you make this calculation, is 22.6% of the salary. That is the insured amount of partner pension. So you could say, then I use this percentage for the total employee group. But of course, if you make this calculation again for an employee that is with the age of 50, the outcome will be different and the percentage will be different. So therefore, there will be a lot of differences if you calculate it back to the percentage of the salary for the partner pensions. So, for example, what you do is always to make a partner pension analysis for the companies to make a calculation. Okay, what is the most suitable percentage you could take from the salary to use for all employees? And what you see here, for example, if you want to have the partner pension for all employees be in line at minimum in the current situation, you see the 100% line, and you see the ages on the horizontal line, 20 go up to 60. For the younger employee group, they are quite close. But if you set one percentage that is in line for a 20-year-old employee, you also see that a 60-year-old employee will then get in that situation a 500% higher partner pension. So it means that the partner pension of the 60-year-old employee goes ×5 in the new system because of the change of this calculation. And of course, again, good news for the employee because, yeah, it's a high partner pension. It's good for my partner, but actually, you can imagine that the employer cost, the risk premiums to insure this partner pension, also goes ×5 for this 60-year-old employee. So there is a challenge here to set the new premium, to set the new percentage for determination of the partner pension. Of course, to be in line with the current employee group, to have at least the same pension entitlements for all employees, but still also to keep it within the budget of the company. And you can see that it is quite difficult to use the same budget and have the same partner pension and minimum partner pension for all employees at the same time. So you need to make concessions here. And of course, such a partner pension analysis is the start point to determine the percentage of the new partner pension insurance. Pensions, yeah, I think it's good to know. Probably you know it's also part of total rewards because the employee benefit of the pension scheme is the important one of the total employee benefit part. And for example, if you agree upon compensating the employee, I think it's also good to decide how do you see your total goals of your company when it comes to total rewards. Because if you change a pension scheme, for example, you can give the employee a compensation in the pension scheme itself, but also you can, for example, create a more like a flexible budget for the employee to make their own choices, and then the employee can invest the premium into the pension pot, or he can use his flexible budget to purchase extra holidays, for example. So when it comes to changing a pension scheme or possible compensating companies or employees, I think it's also good to take first one step back. Okay, what are the goals of the company? And based on that goals, you can set the different compensation agreement, for example, but also you can select possibly a different pension provider because your ESG goals are to be a more sustainable employer, for example, and then you can select a provider with the most sustainable pension funds. It also could be a reason to change provider and therefore to take this moment to not only change the pension scheme, but possibly also change the provider. So again, to make it more in line with your company goals. And then, of course, we are talking about more like a total reward package, where pension is, of course, an important topic. Steps to be taken, more like the roadmap to the new system. I think it's good. Now we are at the kickoff. The 1st of July 2023 is the kickoff to the new legislation. We think as a company that it's important to already involve the employees and stakeholders to inform them that you are working on the project, on the process, and also to possibly give courses to the stakeholders, Works Council, for example, that you upgrade the level of knowledge about pensions. If you don't have a Works Council, I think it's good to already form a project group and determine timelines when you think you will go over to the new system. Possibly it could be the end of the contract at your pension provider. Possibly that's a good moment, or maybe there is another strategy, or you are in the middle of a takeover. Possibly that also could mean that you will reevaluate the total pension conditions, and it could be a good moment to already start to integrate to the new pension system. Because from there on, I think it's always a good start point to make an impact analysis. What we do with our clients is to first make like a blueprint of the current pension scheme and the pension costs, and from there on make different scenarios of using different flat rates and using one scheme or two schemes. What is the impact in the long run on costs? What is your budget? So based on that, the impact analysis is a really important thing to do to determine your next steps towards the new pension system. Because the new pension scheme, the future pension scheme, is very important to not only communicate to the employees, but also to get the consent of the employees. And I think the most important thing to get the consent of the employee to be transparent to the employees, and always take them with every step you go to inform them, okay, we are now in this situation and we think we will go to a new scheme at that moment. So there is always transparency to the employees, because it's always a difficult topic for the employees to understand. But if you as an employer are communicating in a transparent way, I think it's a good first step to get the consent of the employees to go to the new system. Finally, the conclusions, we could say in the summary of the changes of the new pension system. Starts in July. Ultimate date is 1st of January 2028. It's a deadline. And I think the defined contribution schemes, that is what it's all about. That will be the future also for pension funds, industry-wide pension funds, and they have to use a fixed premium of maximum 30% of pension base. So this will be the total tax maximum for second pillar pension schemes. Yeah, then the question, two schemes or one scheme with compensation, I think that's the most important takeaway from this webinar, to check your pension scheme, to get informed about the possibilities and the impact on your pension scheme. So you need to know what to do to be in line with the new legislation. And the partner in orphan pension, of course. It's a risk insurance. Currently, it will stay a risk insurance, meaning that you won't accrue any pension capital in your partner or orphan pension insurance. Is just a payout in case of death. And also, of course, when an employee is leaving the company, this insurance will end. This is also important to know. This was the situation, it still is the situation, because as a company, you of course only pay for this insurance in case of an active employee. To help companies to get the pension scheme in line with the new legislation, there are two tools, you could say, we also always help our clients with. And if you are interested in, I can send you, for example, the pension barometer. It's for free. And what we did actually is a survey amongst 100 large employers, and we asked them at what situation they currently have and what they think they will change their pension schemes to. So this gives you more insight in the 100 plus large employers from the current situation and what they think they will change, what they think they, what date, what year they will do the transition. And it gives you more insight of the current state of companies already have started the project towards a new system. So if you are interested in this, of course, please let me or Sylvie know, and we can send you the pension barometer, we call it. So it tells you a bit more about the future of pension changes at the 100 plus for larger employers. I often get the question for companies who will start a new scheme in the Netherlands, or always, what is market practice in the Netherlands? What is the current level of pension premiums in the level? What is the level of pensions in my sector or in the Netherlands in general? I think it's good to know. We also provide in a pension benchmark. This is of course not for free, but I think it's good to know this is there, because what we can do with this is that you can say, okay, I'm in IT sector and I would like to know what is the average of pension premiums in IT sector, because I want to be in line with my pension scheme with my competitors. And of course, we have a lot of data because we have a lot of clients and we have a lot of information out of the market. And based on this information, we have created the pension benchmark, we call it. It's a report of the sector or the Netherlands in general, or a peer group that you like to investigate. So we can combine this information, and it says something about the level of the current pension schemes in the Netherlands, and then you can assess your current pension scheme to this. And possibly it's good for you to know to go forward in adapting your current pension scheme in the new system. Because if you are below level and you thought you were on level, on market practice level, then possibly it could mean that you would like to improve to be more in line with your competitors. So I think this is also good to know. We provide this. It's like I said, not for free, but if you like to have more information, it's always good to reach out. No problem. A lot of information. I can imagine that some things are quite complex, but of course, if there are any questions, please ask. Let me know.
Thank you very much, Maarten. I don't have a new question. I just have a big thank you for the clear information on a very complex topic. I think we all agree on that. If anyone would like to ask a question, you can also just put yourself on mic and you can ask the question directly.
I just have a very quick questions. Is it possible for a company not to provide any pension at all today in the Netherlands?
Yeah, if you did not already provide a pension scheme, yeah, it's still possible to not provide a pension scheme in the future. But of course, if you now provide the employees in a pension scheme, you can't say as a company, we will end this pension scheme, because yeah, it is part of the employment conditions.
Okay.
So you can end it, but then you have to compensate the employees in another way, by paying an extra salary, for example. So,
But if you've never started, you're okay.
Yeah, if you never started, you're okay, and you are not obliged to follow any industry-wide pension funds, because there are CLAs that are saying if you are a company in construction, you need to participate in the construction pension fund. So it's always depending on the activities of the company if an industry-wide pension fund is applicable, yes or no.
Okay. Thank you.
Yes.
Thank you very much, Maarten. Only one short question. Will we get the slides from you?
Yeah, I think Noemi or Sylvie will provide the slides to you, right, Noemi?
Yeah, we will, and we can. I think that
I will, and I
so,
will
yeah.
give them the time as well.
Excellent. Thank you very much.
Okay.
Are there any more questions? Now is the time. And I think that we will send indeed the slides, the replay, and then maybe also the pension barometer, the link to, if that's okay, Maarten?
Yeah. Yeah.
Yeah. Well, if there's no more question, I would like to thank, first of all, Maarten for your, indeed, what is said already a few times in the chat, your clear information on a very complex topic. I think it's still complex, but it's a little bit more clear now.
It is, yeah.
And thank you everyone for attending to this webinar, and I wish you all a great afternoon.
Thank you.
Bye.
Bye.
Bye-bye. Thank you.